Yo, what's up? It's Derek. Let's get something straight. America didn't just build an economy, it built the economy. The US dollar is the global reserve currency. Wall Street is the financial capital of the world. Silicon Valley reshaped human civilization. If capitalism had headquarters, it would have a New York zip code. And yet, the average American feels more financially stressed today than at almost any point in the last 40 years. How can the most powerful economic system in history feel so unstable to the people inside it? That's what we're unpacking. Not fear, not doom, reality. Let's start with facts. U.S. national debt, over $34 trillion. That's more than the entire GDP of most countries combined. Household debt, over $17 trillion. Credit card debt alone has crossed $1 trillion, the highest in history. About 60% of Americans report living paycheck to paycheck, and the median retirement savings for many age groups shockingly low. Now, compare that with what you see online. Private jets, luxury SUVs, entrepreneurs retiring at 29. America looks rich, but the average American household is highly leveraged. That's not the same thing. Here's something nobody tells you in high school. The American economy runs on debt. GDP is largely driven by consumption. Consumption is largely driven by credit. Want a house? 30-year mortgage. Want college? Student loans. Want a car? 72-month financing. Want to build credit? Borrow money. That is normalized, encouraged, rewarded. In fact, the system requires it. Because when people borrow, they spend. When they spend, companies grow. When companies grow, stocks rise. When stocks rise, confidence increases. It's a loop, and loops are powerful until they break.
So hit that subscribe button if you want to earn more and save more, if you want to feel free and feel calm. All right, let's look at the modern history. In late 1990s, easy money fuels the dot-com bubble. People buy internet stocks with no revenue. 2000, crash. In early 2000s, cheap credit fuels housing boom. Banks hand out mortgages like candy. 2008, collapse. 2010s, zero interest rates fuel stock buybacks and asset inflation. Markets hit record highs. 2020, pandemic hits. Government prints trillions. Stimulus checks. Asset prices explode again. In 2022 to 2023, inflation surges to 40-year highs. The Federal Reserve raises rates aggressively. Cycle. Easy money, asset bubble, euphoria, collapse, rescue, repeat. It's not random, it's structural. After 2008, the Federal Reserve slashed interest rates to nearly zero. Then they began quantitative easing, buying bonds, injecting liquidity, expanding their balance sheet to historic levels. It stabilized the system. It also inflated assets. When rates are near zero, risk feels safe. Money flows into stocks, real estate, crypto, speculative assets. But when inflation spikes, the Fed has to reverse course. And here's the brutal truth. Rate hikes don't hurt billionaires first. They hurt small businesses, mortgage holders, young families, middle-income earners, because leverage is heavier at the bottom. Let's talk about the American middle-class man. He's not reckless. He works. He provides. He wants stability. But here's what's changed. Home prices have surged dramatically relative to income. Mortgage rates doubled in a short period. Groceries, up. Insurance, up. Healthcare, up. Rent, up. Wages rose, but not at the same speed, so the gap gets covered with credit. That quiet monthly stress builds. It doesn't look like panic. It looks like skipping investments, delaying vacations, postponing having another child, working longer hours. Financial stress doesn't just affect wallets, it affects identity. For many American men, providing equals purpose. When providing feels harder every year, confidence erodes, and capitalism runs on confidence. Here's the subtle trap. On paper, many Americans look wealthy. Their home appreciated, their 401k grew, their net worth increased. But much of that wealth is tied to inflated asset prices, and inflated prices are often supported by low rates and liquidity. When rates rise, asset growth slows. Paper wealth feels solid until liquidity tightens. Real wealth is cash flow and flexibility. Paper wealth is valuation. There's a difference.
Inflation is not just an economic metric, it's a psychological tax. When prices rise faster than wages, purchasing power declines. You may earn more dollars, but those dollars buy less. Historically, inflation above 5 to 6% reshapes behavior. People hoard, they panic buy, they shift investments. In the 1970s, inflation devastated savings. Interest rates eventually spiked near 20% to kill it. Today's inflation spike wasn't identical, but the lesson remains. Money printing has consequences. Always. Is American capitalism collapsing? Short answer, no. Long answer, it's evolving under stress. The U.S. still has the strongest capital markets, the global reserve currency, innovation leadership, military dominance. But dominance doesn't mean immunity. The middle class is thinner than it was decades ago. Income inequality is wider. Housing affordability is stretched. The next recession, whenever it comes, won't just test markets, it will test households, and households are more leveraged than ever. Every major crisis reshuffles wealth. Those who are over-leveraged lose flexibility. Those who are liquid gain opportunity. This happened in 2000, 2001, 2002. It will happen again. The system doesn't collapse. It resets. The question isn't whether capitalism survives. It's who thrives within it. What this means for the average American man. This isn't about fear. It's about awareness. In uncertain systems, discipline beats ego. Liquidity beats lifestyle flexing. Skill building beats speculation. Long-term thinking beats short-term hype. The loudest people online often borrow the most. The quiet builders compound. Financial resilience isn't flashy. It's boring. And boring wins cycles. The real breaking point. American capitalism isn't breaking overnight, but it's under pressure. Debt levels are high. Cycles are tightening. Confidence is fragile. The middle class stands at the pressure point. The future won't belong to the loudest. It will belong to the prepared. Because in every cycle, there are two types of people, those who panic and those who understand the pattern. And patterns don't lie. If this episode made you uncomfortable, good. Comfort doesn't build wealth. Clarity does. This channel isn't about hype. It's not about get rich quick. It's not about pretending the system is fair. It's about understanding how it actually works. We break down the cycles, the data, the psychology, the pressure points, and the opportunities most people miss. If you want surface-level optimism, there are thousands of channels for that. If you want to understand the game beneath the headlines, subscribe, because the next episode goes deeper. We're breaking down how debt really drives America and why the engine can't simply stop. Hit subscribe, turn on notifications, not because I need it, because staying financially blind in this decade is expensive and awareness compounds. I'll see you in the next one.